This accounting mini lecture covers accounts receivable turnover. Accounts receivable turnover basically tells us the number of times that we are able to turn over or collect our accounts receivable within a given year. The simple formula for accounts receivable turnover is net sales divided by average accounts receivable. Now, for our purposes in the course, when we are computing average accounts receivable, we are going to compute a simple average. Okay, to compute a simple average, we'll simply take the accounts receivable balance from the prior year plus the accounts receivable balance for the current year and then divide that total by 2. And that gives us a simple average for the current year. Now, let's look at an example here. Here we see they have compared two companies that are in a similar industry. We have figures for Dell and Apple for 2008 all the way through 2011. Okay, so let's look at Dell for 2011. In this case, they've taken the net sales for 2011 divided by the average accounts receivable for 2011, and they have computed an accounts receivable turnover of 10. Okay. Now, in contrast, let's look at Apple. Apple has a substantially higher accounts receivable turnover. It looks like they were able to turn their receivables over 19.9 times in the same year. Based on their net sales and average accounts receivable. So basically what this would tell us is that in general, Apple is able to collect their receivables much more quickly than Dell. And that brings us to another measure. Once we have our accounts receivable turnover, we can very easily compute the days sales uncollected. Sometimes this will be called days sales outstanding or DSO. Basically what this tells us is on average, how long does it take us to collect an accounts receivable? How long are we carrying that receivable on the books before we are actually able to collect the cash? Now, to compute the days sales uncollected, we can take accounts receivable divided by net sales times 365 days. And here we see two different companies, but again, they're in the same industry, so it's beneficial to compare the two. This time we have Hasbro and Mattel, and we have their figures for 2007 through 2011. And when we use this formula, what we see is that for 2011, on average, it takes Hasbro 88 days to collect a receivable. That's more than 2 months, okay? Mattel is in a similar position. Their days sales uncollected is also more than 2 months. They're doing a little bit better, though. Instead of 88 days, they're at 73 days. But that tells you about how long it takes to collect a receivable. Now, one thing that is significant about this figure is we have to think about our liabilities and our accounts payable. Generally speaking, most of our accounts payables are going to be due within 30 to 45 days. Therefore, if it takes us substantially longer to collect our receivables, we may run into a cash crunch position at some point. So that's why it can be very, very helpful for management and even outsiders to analyze exactly how long it takes a company to collect those receivables. Thank you for watching this video on accounts receivable turnover.